Welcome back. With this video, we began our discussion of cash, especially as it pertains to bank reconciliations. Let's revisit what was probably the first asset we discussed, cash. Everyone knows what cash is. Obviously, cash includes physical coins and currency, or paper money. Checks and money orders are also considered to be the same as cash. Money in a deposit account with a bank or another financial institution is also considered to be cash, even if that money doesn't technically have a physical form. Cash is the asset most likely to be stolen or misused in a business for obvious reasons. Of all the assets an employee can misappropriate, cash is the most versatile. Cash is obviously important. It is the lifeblood of every business. A business can survive indefinitely without earning a profit or net income, but it cannot survive at all without cash. How do we safeguard cash? Imagine a customer makes a purchase with physical currency. The customer then leaves with his goods, and the money is left in the cashier's register. If you've worked as a cashier in any retail environment, you'll probably understand the following process. As soon as that cashier's shift is over, he or she remits all the money in the till to the cashier's department. This department may go by another name in a retail store. Sometimes, this responsibility may be concentrated in one position, like the store manager or assistant manager, so it's not referred to as a department at all, but the position still functions in the same capacity. In either case, this person will count the physical currency, examine the employee's cash and credit sales, and verify the accuracy of the money in the till. Again, if you've ever worked as a cashier before, you've certainly had this experience. You showed up for work, your manager gave you your till with all the cash to begin your shift, and at the end of your shift, you return to the office, return your till to the manager, you would count your money, and then your manager would tell you how much over or under balance you were in comparison to your register's record. The record from the cash register would also go to the store accountant or accounting department, which would record the journal entry into the system. The amount of cash received will be the debit to the cash account. After all, we can only increase our cash for the actual amount of cash received. Sales from the register's record will be a credit to the sales account. The computerized register record is a fairly ironclad indicator of how much revenue was earned. In a perfect world, these two amounts would match. Let's say an employee had $485 in sales, which matched the amount of money returned at the end of the shift. What if they don't reconcile? For example, what if sales were still $485, but the employee only had $482 in cash? We can't book a debit of any other amount to cash, nor can we change our credit to sales. So how do we balance our journal entry? The answer? We'll book a debit of $3 to cash shorten over. Cash shorten over is an other expense, or sometimes an other revenue account. If this account is carrying a debit balance, it's an expense account. But if it carries a credit balance, it functions as a revenue account. Using the accounting equation, you see that our equity increased by $485, but our assets only increased by $482. We regard that cash shortage as an expense, reducing our equity to match the asset increase. It is possible to have a credit in cash shorten over. It's rare, but it happens. For instance, in this same scenario, if the employee returns with $487 in cash, now we need to credit cash shorten over for $2. In this case, cash shorten over is functioning as a revenue account. Again, this scenario is uncommon. Customers are less likely to rectify being given too little change than too much. Correction. They're less likely to rectify being given more change than too little. So cash shorten over will almost always have a debit balance, but a credit balance is not impossible. The store will then send its cash receipts to the bank for deposit, and it will book its sales journal entries over the course of the month. At the end of the period, the bank will send a bank statement to the business's accounting department. A member of the accounting staff will then reconcile that bank statement to the cash ledger, verifying that what was deposited has been recorded and what was recorded has been deposited. At this point, I want to draw your attention to an important aspect of protecting assets. Any assets, not just cash. Asset custody needs to be separate from record keeping. Note that the cashier could have pocketed some of that cash and taken it home. Similarly, the manager in the cashier's department could have done the same thing. So what was stopping them? The heroes in the accounting department. That's what, or who. The accounting department is using the same transaction data from the register to update the accounting records. Any discrepancy between the cash record maintained by the accountants and the cash deposited in the bank by the cashier's department will be uncovered when the accountants perform the reconciliation. The only way a theft could be concealed would be if the same person was doing both, making the deposits and recording the journal entries. Considering the importance of the bank reconciliation, let's now see how to do one. We start off with our respective cash balances. We have the cash balance provided by the bank statement and the cash balance provided by our books or our general ledger. Our ultimate goal is to determine the adjusted cash balance, or the true amount of cash that is available to the company. We'll do this by adding in and subtracting out the missing items to each balance. If things are sounding abstract, don't worry. I assure you it's a very mechanical process. I'll elaborate more on the principles of doing a bank reconciliation when I go over an actual example. For now, let's finish out this instructional template. To the cash balance per bank, we want to add in deposits in transit. Consider what deposits in transit actually are. It's money we've deposited that the bank hasn't yet added to our bank balance. We've already added these deposits to the book balance, but they have not yet been added to the bank balance. So we must add them to the bank balance to adjust it to the adjusted balance. Next, we subtract out outstanding checks. Similar to deposits in transit, these are amounts that we've already subtracted out from the book balance, but the bank has not yet deducted them from our bank balance. Again, to move to our true adjusted balance, we need to subtract them on our reconciliation. If the bank had made any errors, we would also correct for them here. These 2 to 3 adjustments should convert our bank balance into our true adjusted cash balance. Next, we adjust the book balance for items that were included in the bank balance but have not yet been put into the book balance. First, we'll add collections and interest. Sometimes a bank may collect a receivable on the company's behalf. The bank just adds that collected amount to our balance. It doesn't send the company notification that it made the collection, so we need to add it to our book balance. It's the same reason for interest. Sometimes a bank will pay clients interest for keeping a certain balance. Alternatively, this could be interest collected with a note receivable. In either case, the bank just adds the amount to our bank balance without telling us, so we need to add it to our book balance. Next, we'll deduct uncollectible items, sometimes called insufficient fund checks, or NSF for short. For these items, our customer sent us a check. When we received the check, we debited cash and credited AR, adding it to our cash balance. Then we send it to the bank for deposit. However, the check turned out to be bad, so the bank ultimately did not add that amount to our bank balance. More specifically, what happened is when we included the check with a bunch of others for deposit, the bank added the lump sum into our bank balance, but when that one check turned out to be bad, the bank then subtracted it from our bank balance. The point being is that this amount has been added to our book balance, but it was not added to our bank balance. To rectify this issue, we must subtract it from the book side of our reconciliation. It's at this point that if we made any errors in our own record keeping, we'll adjust for those here by adding or subtracting them from the book balance as needed. At this point, we should have our adjusted cash balance per books, which should match our adjusted cash balance per bank. Once that's completed, our final step is to book journal entries for our adjustments. The cash balance we report on our balance sheet needs to be the true, accurate cash balance reflecting how much cash asset we actually have. Consequently, we'll book journal entries for all the items on the book side of the reconciliation. And at that point, our cash balance will be accurate. Consider the following information for North Collegiate Athletics. Let's use this data to build a bank reconciliation and then prepare the adjusting journal entries. We always start off our reconciliation by listing the cash balances per the bank statement and the books. Those were the first two items given to us in our information, so we'll list the bank balance on the left side. Next, we'll put the book balance on the right side. Item C tells us that a deposit was made on the last day of August, but not in time for the deposit to clear the bank that month. Deposits in transit will be added to the bank side of the reconciliation. When we received the check from our customer, we debited it into our cash's ledger balance. But the bank has not yet added it to our bank balance, so we need to add it to the bank side of our reconciliation. Item D tells us that the bank collected a note on NCA's behalf. The bank simply added these collections to our bank balance without telling us. so we need to add them to our book balance. Item E lists our outstanding checks. We cut these checks and sent them to our vendors, and we credited them out of our ledger account when we did. However, the vendors have not yet deposited the checks. In other words, they've been deducted from the book side, but not yet from the bank side. So we need to do so on the bank side. Item F tells us there was a debit memorandum on the bank statement for an NSF check. We received a check from our customer, which we debited into our cash account, then sent it to the bank for deposit. The bank added the sum of those deposits to our account, but when the check in question turned out to be bad, it subtracted that amount back out from the bank balance. Consequently, we must subtract it from our book side of the reconciliation. Finally, item G tells us that we wrote a check for $165 to pay a bill, but we incorrectly entered it into the ledger as $156. Since the check was written for $165, that's the amount that was taken out of the bank balance. However, we mistakenly only subtracted $156 out of the ledger. $9 too little. So that's the amount we have to subtract out of the book side of our reconciliation. With everything listed on our bank reconciliation, we only need to sum up both columns and verify that the adjusted balance on the bank side matches the adjusted balance on the book side. Our cash balance is reconciling. We now need to book our adjusting entries. The idea here is we want our records, the cash balance, to report the true amount of cash we have available at this date. Our cash balance right now is $10,381. We want it to be $11,740. To achieve this result, we'll debit cash for our additions and credit cash for our subtractions. Regarding our notes receivable and interest collected, we'll debit cash for their sum, $1,480. We'll credit notes receivable for the face value of the receivable being collected, $1,400, and we'll credit interest revenue for the interest earned, $80. regarding our two items being subtracted. We could record these items in one journal entry or two. I'm going to record them in two so I can go over the specifics of each entry. Starting with our NSF check. When we originally received this check, we debited cash and credited AR. We presumed this check was good and that it was satisfying an amount owed to us. But since it wasn't, we're having to subtract cash out of our ledger account. That's our credit. This customer still owes us $112. We don't consider his obligation satisfied because he sent us a check that was bad. We're going to reinstate this receivable and send that customer a notice that he still owes us $112. As for the miskeyed check, this was for a $156 disbursement in payment of an expense. But the amount of the journal entry was $9 too little. If it helps, consider the impact on the expense account. We debited it for $156, but we should have debited it for $165. To yield the correct amount, we'll debit expense $9, and now expense has received the correct debit of $165. And of course, we credit cash $9. When dealing with errors regarding miskeyed checks, just look at the original entry and just use the other account for your debit or credit. For instance, if this had been a cash payment for the purchase of supplies, we'd debit supplies in our adjusting entry. If this had been a cash payment to satisfy an account payable, we debit account payable in our adjusting entry. Regardless of what we debit, we'll credit cash. With this entry posted, the balance in cash becomes $11,740. It now aligns with our adjusted balances. Feel free to pause the video here and check my math. That concludes this video on bank reconciliations. Come back next time and we'll go over petty cash. Thank you very much for watching. If my videos are helping you and you want to return the favor, you can leave a thumbs up or a question or comment below. If you really want to help, consider subscribing to my channel. Not forever, just for however long you're taking your accounting course or courses. And finally, feel free to share my videos with your fellow classmates and even your professor. I'd like my videos to help as many students as possible, and I wouldn't mind getting some feedback from contemporaries. Thank you once again, and I'll see you in the next one.